Hello and welcome. In this video, we look at the Central Bank Gold Agreement. In May of this year, central banks signed the Fourth Central Bank Gold Agreement that goes into effect on September 26. The signing of the Fourth Central Bank Gold Agreement reasserts by central banks the importance of gold as an asset in global monetary reserves. The First Central Bank Gold Agreement was created in 1999 and was known as the Washington Agreement on Gold. At the time, central banks held about 33,000 tons of gold, which was about a quarter of all gold estimated to be above ground. The Central Bank Gold Agreement was created because market fears about central bank intentions on gold caused the price of gold to decrease and become less stable. In addition, it caused an instability in the value of the assets of central banks. This was also causing considerable hardship for gold-producing countries, many of which were heavily indebted poor countries. The Central Bank Gold Agreement was signed by 15 European central banks. The 11 central banks of the countries that were at the time members of the Eurozone, and also by Sweden, Switzerland, the UK, and also the ECB. In addition, a number of other major holding central banks, including the US, Japan, Australia, the IMF, and the Bank for International Settlements, either formally associated themselves with the agreement or announced that they would not sell gold. With a 5-year lifespan, a new agreement that contains basically the same language has been signed every 5 years. The agreement stated that gold would remain an important element of global monetary reserves, and it agreed to limit the total combined sales of gold by central banks to 400 tons a year. They also agreed that their lending and use of derivatives would not increase over the same 5-year period. In the press release for the First Central Bank Gold Agreement on September 26, 1999, central banks stated the following, quote, "In the interest of clarifying their intentions with respect to their gold holdings, the undersigned institutions make the following statement. Gold will remain an important element of global monetary reserves. The undersigned institutions will not enter the market as sellers, with the exception of already decided sales. The gold sales already decided will be achieved through a concerted program of sales over the next 5 years. Annual sales will not exceed approximately 400 tons, and total sales over this period will not exceed 2,000 tons. The signatories to this agreement have agreed not to expand their gold leasings and their use of gold futures and options over this period. This agreement will be reviewed after 5 years." Unquote. In 2004, the Second Central Bank Gold Agreement was signed. For the Second Central Bank Gold Agreement, the wording was basically the same as the first one, except the limit on the maximum total gold that central banks could sell was increased from 400 tons a year to 500. In 2009, the Third Central Bank Gold Agreement was signed. For the Third Central Bank Gold Agreement, the wording again was basically the same, except the limit on the maximum total gold central banks could sell was decreased back down to 400 tons a year. And there was a statement about the intentions of the IMF to sell gold to several central banks. Most notably was a 200-ton sale from the IMF to the Central Bank of India. For the current Central Bank Gold Agreement, the wording on the limits for selling gold were changed to state that the signers of the agreement have no plans to sell significant amounts of gold. This change was made because during the previous 5 years, central banks went from net gold sellers to net gold buyers. It was also stated that the signers will coordinate their gold transactions so as to avoid market disturbances, which explains why, when we look at the graph of central bank purchases, the amount of gold central banks have been buying each year is a fairly consistent amount. So that is the Central Bank Gold Agreement, a commitment by central banks to coordinate their transactions of gold because, in their words, gold remains an important element in global monetary reserves. I hope that you enjoyed this video. Thanks for watching.